Welcome to my first video in my new role as Chief Investment Officer of DWS. I'm starting with an investment outlook for a year that we expect to be rather challenging. After 2 very good years in markets, we have to be prepared for some surprises, especially from a new US administration. Nevertheless, we're optimistic about the year ahead, even if the risks to our core scenarios are larger than average. Here's one reason. Imagine if I told you 5 years ago that the world has had the COVID pandemic, which destroyed supply chains, war in Europe and the Middle East, and record inflation. Who would have thought that despite all of this, the S&P 500 would have almost doubled by today? What I'm trying to say is that perhaps we too often underestimate the economy's ability to adapt to serious challenges. People find solutions to problems, sometimes faster, sometimes slower. And from today's perspective, the foundations for a successful investment year in 2025 appear to be in place. Growth and inflation trends in the major economies are normalizing. We do not expect a recession, and corporate earnings should continue to rise. This is a good environment for almost all asset classes, even though many uncertainties remain in 2025. What is driving the bond market in 2025? 2025 looks like it will be good for bonds. We expect a normalization of growth and inflation trends in the major economies. In the US, we expect economic growth will slow slightly from 2.7 to 2%. In Europe, we believe it will increase slightly to just under 1%. Due to Trump's expected tariff policy, we have reduced our 2025 growth target for China's GDP to 4.2%. We believe that the Trump administration poses risk to inflation. We therefore now expect less cuts from the Fed, with the Fed funds reaching 4% at the upper end in December 2025. With weaker growth in Europe, we expect the ECB to do more cuts than the Fed, leading to a deposit rate of 2%. However, both central banks will have to continue to take a short-term view and balance inflation and growth risks. We expect government bond yields to trade in a similar manner to 2025, sideways with high volatility. At the same time, we think the US Treasury market could react if rising debt and inflationary risks are ignored. In that case, it could exert some discipline on the US administration. Credit spreads on corporate bonds have already tightened so much that we do not expect any further impetus from them. However, in our view, the current all-in yield is enough to maintain the attractiveness in this asset class. We favor the investment-grade segment as we fear increasing idiosyncratic risks in the high-yield segment. Import tariffs and expansionary economic policy should initially give the dollar further tailwind. We see it at 102 against the euro in 12 months. Have US equities become too expensive since the US election? We believe there's continued support for equities in 2025. No recession, moderate economic growth, and rising corporate profits. On top of that, they can offer some protection against inflation surprises. After 2 very strong years with around 20% return for the MSCI World, we now expect total returns in the high single digits for various regions. For the S&P 500, for example, we have a target of 6,500 by the end of 2025. But for that to happen, a number of things have to go right. It's important, for example, that the 10-year US Treasuries don't approach the 5% mark again. The big technology stocks must continue to show decent earning growth, and investors shouldn't be put off by erratic politics. Although we expect the highest return in the US, we're not prioritizing the US over other regions, as there are other possibilities globally, and we have to diversify high concentration risks. European equities are still very cheap compared to the US, but we do not see any outperformance without a significant improvement in the manufacturing cycle. Emerging markets are likely to struggle in 2025 against the backdrop of a strong dollar, US tariffs, and weaker earnings growth. A lot has already been priced in. However, should the correction continue, we would see opportunities, for example, in India's equity market. Even though we're optimistic about the coming year, Be ready to be surprised. We see gold as a good portfolio hedge with a target price of $2,800 an ounce. Further diversification may be offered by alternative investments. We see encouraging signs of a revival in the prime segment of real estate markets, both in Europe and the US.